Most investors who bought growth stocks in 2021 lost 50 to 80% of their money. Not because growth stocks are bad, because they had no framework for valuation. They were buying stories, not businesses. This video gives you a precise 5-step framework. It tells you exactly how to value any growth stock, without guessing, without hype. The framework is called the ClearMarket Concept Clinic. It works on Nvidia. It works on Amazon. It works on whatever stock your feed is pushing today. Why does this matter in 2026 specifically? The Federal Reserve held rates above 4% for 2 consecutive years. Historically, that single fact changes growth stock math dramatically. Here is a real example. In 2021, Palantir traded at 40 times revenue. The data shows that was never a defensible number, even under optimistic assumptions. By 2023, the stock had lost 80% from its peak. The business did not collapse. The valuation did. Understanding that distinction is the entire job of a disciplined growth investor. The good news, growth stock valuation is not as complex as Wall Street makes it sound. There are 5 things that actually matter. We are going to build through each one, step by step. A growth stock is a company expected to grow revenue significantly faster than the broader economy. Typically, that means revenue growth above 15% annually. Often it means no profits today in exchange for much larger profits tomorrow. That deferred profitability is exactly what makes valuation hard. You are pricing a future that has not happened yet. Every dollar of future profit is worth less than $1 today. That is the time value of money. When you discount future cash flows at a higher interest rate, their present value shrinks dramatically. Based on the numbers, a company with profits arriving in 2030 is worth roughly 20% less today than it was when rates were near zero. This is why growth stocks are hypersensitive to interest rates. It is not sentiment, it is math. In 2014, Amazon had almost no profits. Critics called it overvalued for years, but the data showed something different. Revenue was compounding at 20% annually. AWS was emerging as a high-margin engine. Analysts who used a price-to-sales ratio adjusted for growth. Specifically, the PEG ratio on revenue could see the trajectory. The lesson is not that Amazon was cheap. It was that its growth rate made a high multiple defensible. That is the core logic of growth stock valuation. Growth earns the multiple if it is real and durable. You do not need a Bloomberg terminal. These 3 metrics are available for free on most financial data sites. Metric A, price-to-sales ratio, PS, adjusted for growth. Divide the stock's PS ratio by its revenue growth rate. If Nvidia trades at 20x sales and grows at 80% annually, that is a ratio of 0.25. Historically, a ratio below 0.5 on this basis suggests the growth is not fully priced in. Metric B, rule of 40, add the company's revenue growth rate to its free cash flow margin. A score above 40 indicates a healthy growth business. Salesforce scores above 40. Snap has struggled to reach it. The data shows this metric separates durable growers from cash burners. Metric C, discounted cash flow. Simplified, estimate revenue. 5 years out at the current growth rate. Apply a reasonable long-term profit margin, 15 to 25% for software. Discount those future earnings. Back at a rate reflecting current interest rates, roughly 5 to 7% today. Compare that present value to today's market cap. If the market cap exceeds your calculation by more than 50%, the stock is pricing in perfection. This is the section that saves portfolios. 3 mistakes appear consistently across retail growth investors. Mistake 1, conflating a great product with a great investment. Nvidia makes exceptional chips. That fact alone tells you nothing about whether the stock is fairly priced at any given moment. Mistake 2, using PE ratios on unprofitable companies. A company with no earnings has an infinite PE. That metric is meaningless. Use PS and Rule of 40 instead. Mistake 3, anchoring to a past price. The stock being down 60% from its high does not make it cheap. It may simply have been 60% overpriced before. There is a fourth mistake worth naming. Ignoring the discount rate environment entirely. Historically, the period with the highest growth stock returns was 2010 to 2021, precisely because rates were near zero. Based on the numbers, that tailwind no longer exists in 2026. Higher rates structurally compress growth multiples. That does not mean avoid growth stocks. It means price them accordingly. To illustrate the framework in action, here is a partial signal score on Nvidia, using only publicly available data as of mid-2026. Business quality, 8 out of 10, dominant GPU market share, 80% data center. CUDA moat is deep. Revenue compounding at 120% plus FY 2024. Valuation, 5 out of 10 PS, 30x at current prices. Rule of 40 score 100. DCF suggests 15-30% premium to base case at 6% discount rate. Momentum, 8 out of 10. Strong earnings beats for 6 consecutive quarters. Data center demand accelerating into 2026. Risk, 6 out of 10. Export controls on China sales. Customer concentration, Microsoft, Google, Meta, past 40% revenue. Competitive pressure from AMD MI300. Sentiment, 7 out of 10. Institutional ownership increasing. Short interest low. Analyst consensus positive but crowded trade. Total score, 34 out of 50. The business quality is exceptional. The valuation demands that the AI infrastructure build-out continues at pace. Any deceleration reprices this stock materially. The data does not ask you to be bullish or bearish. It asks you to be precise, 5-step framework. 3 metrics. 1 signal score, that is the entire system. Use price to sales adjusted for growth. Run the Rule of 40. Build a simplified DCF with today's discount rate. Then ask, is the multiple justified by the growth? Or is the market pricing in a future that may never arrive? If you want to see the full signal score on Tesla, it drops Thursday. Subscribe and turn on notifications.